Hello, my name is Kaishu Wu. I am an assistant professor at the School of Accounting and Finance, University of Waterloo. I am promoting this research I have with Ken Claassen at Waterloo as well, and Sean Huang at Arizona State University, and Mark Ma at the University of Pittsburgh. The title of our study is Does the Tax Deductibility of Interest Affect Financial Reporting and Investment? So in this study, we're looking at a set of rules that limits the interest deductibility when calculating a firm's taxable income, LID. It is a tax policy that has been widely adopted by many countries, including Canada and the United States. And the purpose of this policy is to combat cross-border tax avoidance and protect tax revenue. So basically, a lid would impose a threshold based on which excessive interest expense may be disallowed. So for example, if a firm's debt to equity ratio or interest expense to earnings ratio is beyond a certain point, a part of the interest expense reported will be disallowed. Okay, so naturally, the first response that firms have to LID would be to reduce their reliance on debt financing. That is what price studies have found. Um, the firms in a country that adopted LID would reduce their leverage. Okay, so what we are interested in our study is whether and to what extent LID would affect a firm's financial reporting and investment efficiency. The reason why we are interested in financial reporting and investment efficiency is that in the first place, prior studies find that debt financing is associated with more conditional conservatism in financial reporting, where conditional conservatism means that a firm will release bad news more timely than good news. Okay. And in the second place, prior studies also find that conservatism in financial reporting is associated with higher investment efficiency. So if LID will reduce firms' reliance on debt financing, we would expect that firms will become less conservative in financial reporting, and their investment efficiency will also suffer. In our archival study, we use a sample of firms from OECD countries to test our hypothesis. We used roughly 38,000 firm year observations from 1985 to 2013 and a staggered diff-in-diff model in order to sharpen identification. In our tests, we first confirmed that leverage indeed decreased after LID. On average, firms in our sample dropped their leverage by 1.3 percentage points, which is economically significant. Then, in our main analysis, we use a cash flow-based Bassus model and show that conditional conservatism indeed dropped after LID. In other words, firms indeed become faster in reporting bad news in comparison to good news. Now, this finding is more pronounced for firms with a higher leverage and those subject to higher statutory tax rates and stronger protection of creditor rights, which suggests that the effect on conservatism is through the reduced use of debts. Next, we show that investment efficiency deteriorated after the adoption of LID. Investment efficiency is worsened in the sense that firms that have the tendency to overinvest now would invest even more, and firms that tend to underinvest now would even invest less. Additional tests show that the effects on investment efficiency is more pronounced when the level of conservatism is low, which is consistent with the notion that the reduction in conservatism is the channel through which the reduction in investment efficiency occurs. Finally, we move from a cross-sectional cross-country setting to a single country setting using the 2017 US TCJA, and we find consistent results in terms of conservatism and investment efficiency. The benefits of a single country setting, one of the benefits is that it alleviates the concern that our findings are due to cross-country differences that are actually unrelated to it. Overall, we believe that our study provides evidence on some unintended consequences of a tax policy. First, there's a reduction in conditional conservatism as an attribute of financial reporting. And second, and perhaps more importantly, there will be a reduction in investment efficiency, which is likely more of a concern for policymakers because investment efficiency is directly tied to economic growth and job creation. In terms of the contribution to the academic literature, our study shows a causal relationship between cost of debt and conditional conservatism, whereas prior studies in the literature only showed an association between the two.